So this particular unit that we are going to be covering today, which is law for accounting, is a generic unit again, but what we want to do is contextualize this in terms of our understanding of why this is required when we study law, and what are the basic bits of law that are going to be covered when we work when we work in the accounting and finance field. So whether it's working as a financial accountant when you're dealing and providing services to clients, or in general dealing with accounting regulation, filing of tax, things like that. The idea would be that as an individual who has completed this module, the idea would be to try and understand why a law is important and what remit of law, because law is obviously a quite a big subject. So what we want to be able to do is narrow down to the areas wherein we would use some parts of the law, contract law, for example, law of torts, for example, some of the trading regulations or acts which are there. And those are the ones that we need to be aware of when we are looking at, obviously drawing up financial statements or dealing on behalf of our clients, or, obviously dealing with financial instruments. So we need to be able to understand the application of the English legal system or English laws in particular when we look at, the application of them within the accounting field. So the whole unit is basically looking at giving you a bit of a bird's eye view, or I would say a macro understanding of how the English laws impact businesses and organizations. And when we look at dealing with financial transactions, or probably the fair word to say would be when we're providing professional accountancy and financial services to our clients, what would be the various bits which would be important for us to be aware of, have knowledge on, and how do we rightly use or correctly put that into use when we are looking at dealing or creating documentation. Now, this particular unit obviously is graded. All the units that you want to study for the IFA, practicing membership would all be graded, so pass, merit, and distinction. So obviously the unit specification is a document that you see on your screen, is the document that most of us will be using primarily to do the teach, so to ensure that most of the contents which are provided as indicative contents are covered in the presentation and our discussion and the lectures that we do. And there are 4 learning outcomes in particular that we're going to be looking at. So there are 4 lectures followed by a lecture on the assignment discussion. Today we are going to be concentrating on the first part, which is the LO1, and the LO1 will pretty much include, discussing the various elements of law. Along with that, it will also include the assessment criteria, which are in pass, merit, and distinction, category. So we're going to be looking at the three Ps, essentially 1.1, 1.2, 1.3. There'll be some bit of analysis and assessment of validity of contracts in merit. And then we are going to be looking at a bit of evaluation in terms of when we talk about law of agency or people acting on behalf of their clients as agents. The relationship forms is the agency relationship, and the transactions which transact with the third party when the agent is acting on behalf of the client under the agency relationship is what we're going to be looking at in the evaluation part. So looking at covering some bits of the indicative content, which is predominantly given, here, and that would typically be, understanding the elements of contract law. We're going to be looking at the law of agency, or when an agency relationship, starts, when it ceases to exist. We look at 1 or 2 examples of case laws just to understand how is this put into practice. And then we'll also briefly look at covering law of tort, which is a detailed, let's say a detailed field of law in itself. And the idea would be, just like we do a bit of macro understanding of the contract law, we're going to be looking at a bit of macro understanding of the law of tort. And this typically would be covered by looking at some of the elements and constituents of, what is the law of tort, what is the tortious, what would be the example of when somebody acts and this law needs to be invoked. And then we look at some of the remedies and, relevant cases. So the relevant cases that we are going to be looking at would predominantly be helping you understand the application of this from a context. So these cases, I'm going to try and provide you a reference website wherein some of these cases are, clearly given out and present. But there are also handouts that we've created, which are summaries, in 1 page for some of the cases, just for you to look at to understand the practical application. So the bits on the first learning outcome is what we're going to get into today. And obviously, I have a few slides that have been prepared in order to cover the indicative content and obviously discuss some bits of this that we look at from our point of view of, the law for accounting. Now, for those of you who have, I know there are some of you who have had exemptions from financial accounting or, business ethics or corporate ethics. There are bits and pieces of this to be spliced into this particular unit, because when we talk about ethics, corporate social responsibility, we look at accounting scandals which have happened in the past, all this, and then we look at the bits which are predominantly related to, the standards that have to be applied, which is the principles of accounting, financial reporting, which have to be applied when we prepare these financial statements, which are sent across, at the end of the year to Companies House, have to conform with certain standards. And that is where the implication or the application of these law guidelines typically tends to come in. And I'm going to try and show you, obviously, slides from one or two different presentations, which I've included here, but there would be some additional reading that you would need to do just to put this into context when we cover the legislation part of it, in terms of contract law and law of tort for this unit. So is that okay? So far, so good?
Yeah.
So I've got a dog, somebody in the background.
That's mine. Yeah, one nutty boxer dog.
All right, okay. Good stuff. Okay, so as I mentioned, the aim of this module or the unit that you're going to study is predominantly to apply and understand the role of law essentially in accounting and accounting practices. Now, before I start, let's look at getting into some key concepts, or let's put it this way, a bit of an overview, just to put a few terms and key terms or terminology into perspective. So when we talk about, so I've got somebody joining in, that's great. So when we talk about, for example, law, and when we talk about in general, the various elements of law, I think most of you are familiar with, law can be divided into two different types. So one is public law, and the other is private/civil law. Public law is the field of law that essentially is used to bring, justice or, maybe cases against or hold the government accountable. So when you see, say, for example, a case coming into the court which is going to be trying the government or government body, for example, you're not happy with the council and you've filed a case against the council. So obviously you're looking at basically dealing with the government itself or the, one of the bodies which looks at running some of the facilities or, the, say, for example, providing certain services in an area. And if you're unhappy with that particular service being provided, then you bring the government or that body of that government to the court. And in those cases, when the government deals with members of public or the vice versa, then in those cases, we look at basically public law being used. So this is basically, in short, when you bring a case against the government or any government body or the vice versa, which is the government looks at using law as a way to, look at defining the, let's say, the role of law and rule in terms of the country or in a particular geography, then they would exercise what is called the public law and use this to, govern and obviously, bring out, make sure that the citizens or members of public actually abide by the law. The other side of the law is private/civil law, and this is divided into different types. So if you deal with, let's go back to the public law. So if you deal with, say, for example, an offense wherein you've had a theft in your property, or if there is a theft which has happened in the house or in the office, then in those cases, if there has been some harm which has been done, say, for example, somebody's got injured or, there was an intended harm to be done, then in that case, under public law, you have criminal law, which will be applied, and the cases will be tried under that particular system. There could be constitutional and administrative sides of the public law. Constitutional tends to be, if you remember the Gina Miller case, which was brought across by the businesswoman Gina Miller, when obviously the Parliament was prorogued by Boris Johnson. So she said, no, the activities of the Parliament cannot be prorogued, should not be stopped. And she filed a case in the Supreme Court. Similar thing was done in Scotland. And obviously, this was found against the Constitution. And this side of law that we saw or witnessed, the case which went on, and obviously, Gina Miller won that case against the government, was an example of constitutional law, wherein the duties of the Parliament should not have been stopped to pass the Brexit legislation, which the Tory government at that point in time and Boris Johnson, as the Prime Minister, tried to do. So the Parliament was recalled, and that was an example of constitutional application of public law. There are lots of different applications of public law that we get to see in administrative reviews or judicial reviews, which typically tend to happen wherein you challenge a ruling, and those are then covered under that. Criminal law, offences, thefts, murder, those kind of things, bodily harm or intended bodily harm, which could harm the individual or, members of public, would all be covered under, criminal law. So when you see the unrest which happened when the government is trying to introduce new laws and legislations related to, how long can we protest, what are the protest timings, what could be used for doing, say, peaceful protest. And there was a lot of, what we saw in the news in the last couple of days was the violence and, the members of public, creating scenes in Bristol against the police, burning of property. So when people would be tried and convictions will be brought or they will be booked, they'll be done under the pretext of criminal law, because here there was an intended harm by some of the protesters to be, damage public property, or, it could lead to a loss of life. And that is why they will be criminal, if at all any bookings or any in convictions are made, they will come under criminal law, because they're all dealing with the public side of things, wherein either the state or the individual is involved. And in both the cases, they would basically be taking the route of public law. Now, when we talk about private law and when we talk about civil law, there are again different types here. So you have contract, you have tort, which is what we are going to refer to today. Then there is property, there is trusts, and there is family. And then you also have immigration and a couple of other, divorce law and things like that, which also fall into some of the further subdivisions of what is called the civil law. So this is just an overall view or a small chart which basically explains, how do we look at law in general, what are the various branches of law, and then how some of these cases, fall into different types of courts when, you have these judgments and other, obviously rulings being brought out or people going to court to get some remedy. Now, after this brief understanding, if we look at, what is contract law, which is what we need to understand, then what we want to do is understand in terms of when a contract is formed. So as contract law says, when a contract is being formed, that means there's an offer, there's an acceptance, there are some parties involved, and there are some, terms and conditions which are defined, and there are some terms and conditions which are defined if the contract is not to be honored or if the contract is not to be fulfilled, then you would generally see that some of these things come into play. So when we talk about contract and not an agreement, we talk about contract. That means it has been formalized, it has been inked, or you say that it has been signed by both parties, the agreement has been signed by both parties, then that document, which is enforceable by law, actually becomes a contract. And when we talk about a contract, a simple contract would be a telephone contract that you take out, your mobile phone contract that you have a tenancy contract. The contract between you and your client as an accountant is a contract. Anything which is signed and has certain terms and conditions and deliverables defined in it, wherein both the parties agree to those and then sign it, ink it at some stage, would become a contract, and that would be then enforceable under the rule of law or under the, under some sort of law, and that would come under what is called contract law. Now, essentially, a contract has lots of different elements, because initially you start off with discussions, that is basically showing intention. At some stage, these intentions are started, you start writing these down. Okay, in my accounting practices, if I'm going to offer you an X fees, I will include payroll, I will include, say, for example, yearly, submission of accounts. It would also include, for example, any exigencies, bookkeeping, whatever things that you agree on, and those have been taken across or taken forward from discussions onto a bit of a certainty, and they are going to get into some sort of a writing in terms of inclusions on a paper with with the elements of the law wrapped around it, which is a contract wrapped around it, they will then be one of the elements of, contract. And at some stage, you look at some considerations, you look at some, exigencies, you look at, for example, exceptions in some cases, and in what capacity. That means the contract would be signed. Would it be signed by the company? Would it be signed by an individual? Would it be between two companies? So those kind of things, when you look at, they form the various elements of contract. And we see this happening on a day-to-day basis, whether it's in personal life or we see this happening, on the corporate side, on the business side. So when some sort of an agreement happens and that is basically being inked, and also it is signed off by both the parties, somebody who's offering some services and somebody who's accepting the services on the other side. And when this is agreed, then it becomes what is called a contract. Now, there could be different types of contracts, and I've only put few examples here, things like employment contract, lease contracts or agreements, hire purchase agreements, you look at insurance agreements, financial agreements, they are all forms of contract. Now, contract law is a different unit altogether, but how do we summarize it and we look at it from a point of view of what parts or elements of it are important in accounting that we need to know? So when we look at this particular, flow chart, which basically explains, in terms of what is a contract. So contract starts off with a bit of an agreement. When all these 7 elements are complete and it's being signed off, then you have an agreement which is basically enforceable by law, and that becomes a contract. So contract has an offer or an offeree, somebody who's offering to, provide some services, and on the other side you have somebody who's accepting those services, and that's why they sign and agree to that, and then it becomes a contract. Now, when we look at terms, there are lots of different terms which can be in contracts. There could be terms which have some exclusion clauses. So when you hear of clauses like, if there is a hand of God, when I refer to that, what I mean by that is you look at if there are earthquakes, fires, floods, things which are beyond your control, which are natural, or environmental, situations which cannot be controlled, then sometimes you would see these are included in the contract as what is called exclusion clauses. And these exclusion clauses basically have to be a part and parcel of most of the agreements, or most of the contracts that we see which are signed, and they tend to be, included under a separate heading in the contract under the terms, and they are exclusion clauses. Then there are some common law rules, which could be basically looking at when we say that this contract, if there are any disagreements or if it needs to be taken to court, then this will be settled, in the courts in England and Wales. So when we look at defining where this law, where this contract, if it is to be taken to court, has to be settled, then we will define if the jurisdiction in which these are to be settled, and they would be covered under, certain terms, and they will be clearly mentioned under, common law rules. Then we look at statutory rules which have to be followed. If there are certain goods and services being exchanged, and you generally see that these services which are being exchanged or provided, could have implications where regulations could be applied or necessary acts could be applied, they would then be included. So in some cases, when you look at buying goods and services from Amazon, or for example, when you look at buying goods and services from a trader or from a retail store, you would normally see that some of these acts and legislations become important. In our case, obviously, sometimes you see that when you buy goods and services or when contracts are signed, they have a cooling off period of 14 days or 28 days, depending on how they've been defined, because they are basically to cover some part of legislation, which could be looking at the Consumer CCA, Consumer Act of 1976, or revisions which have happened in 2012 and 2015. You look at some of these acts which could be for collection of payments, which generally tend to be there, and they tend to be allowing the parties to legally recover, for example, interest costs on late payments of commercial debts, or interest costs which are under the 1998 Act of Late Payments, Commercial Debt and Interest Act. And then you have these two, most commonly understood acts, which is the Unfair Contract Terms Act, wherein what basically is being mentioned is that the party cannot avoid liability, through the exclusion clauses. You can't put that I'm going to show a description of a product, but essentially when it gets delivered, or you promise a particular service and that service at the end of the day is delivered in a very different form, then what you're trying to do is basically cover some of this under exclusions, but what has been agreed in fundamental principles has not been delivered, and they could be covered under what is called the Unfair, Contracts Act. And then you have a version of this, which is primarily the Unfair Terms in Consumer Contract Regulations Act, which actually replaces the initial act of 1976, and that would basically mean that in this case, some parts of the conditions and terms which are specified primarily in the contract which has been signed would be that what you need to be able to do is make sure that some of these terms which the agreeing party is not familiar about, when we say fine print, needs to be avoided, and these conditions which are required and are important for the contract to be understood actually should not be put into the fine prints, and they should be transparently discussed, and they should form the part and parcel of the regular contract rather than being excluded in either exclusions or in specific terms given in the contract. So an example of this would be when you look at sometimes a trader which will given an example here that I mentioned earlier, that if they've advertised a particular product, and in that case, the product, they've advertised, they have ample quantities and stocks of that product, but when you get that product delivered, you deliver a like-for-like replacement, which is under the claim that, okay, as the product was advertised, there was a small asterisk somewhere which said, if this actual product is not available, the company would be delivering a like-for-like product. And in those cases, what has happened is, by putting some of these under exclusion, the trader has actually misled the consumer, and what they've done is, rather than you receiving, say, for example, a washing machine or a service to say, this was supposed to be delivered, but you've had something very similar or a substitution of that which resembles that, and a good reason or explanation has not been provided, and that would be covered under that. Now, when we look at contracts, we also would look at that there are terms and conditions which have to be invoked when there is a breach of contract. That means the contract cannot be fulfilled, or in some cases the party who is providing the services becomes incapacitated, and in some cases you would see that businesses in this case would go into administration or go into bankruptcy, and they would not be able to deliver their contract. So in those cases, when some of these conditions are invoked or happen, you would generally see that the contract is in breach. So we get to hear this term, that the party which is supposed to be delivering those services, for which some money has been in exchange which will be provided, is not able to deliver the services, and those then lead to what is called non-fulfillment of contract or breach of contract. Now, breach can occur at any given point in time, and if breach occurs, you have terms and conditions which are included. One such example would be, which we look at, breaches that we do on purpose, and they are under the rule of law and as books. And a simple example of that would be, it's not actually a breach, but there is a solution around that breach. Is, for example, you take out a mortgage, and an example on that side would be you take out a mortgage, and most banks specify that you cannot pay more than 10% of the total incomings of the payments which are done for principal, more than 10%. If you pay more than 10%, they put a bit of a penalty clause on that. So, for example, if you're paying mortgages of 2,000 a month, and you generally pay at the end of the year 24,000, but you have some surplus money and you want to pay additional 25,000. Now, because that exceeds the amount, 10% of the amount which has already been paid, and that is mentioned in the clause in the terms and condition, technically speaking, you are in breach of contract, and in order to ratify that breach, what the banks would basically do is charge you a certain percentage as a penalty fee because you're overpaying your mortgage payments. So this is an example which we generally get to see happening, from a point of view of a breach. But a legal way to overcome that breach is that in some of these cases, there are some financial penalties which are put, or when you look at taking out a loan, and you try and the loan contract or the hire purchase contract is 5-year terms, 6-year terms, but you try and do a settlement before that. So in some cases, what companies would do is, in order to get discounted value of money or get to lower the defaults, maintain cash flows, or maybe look at recovering that money beforehand, they might give you a bit of an incentive. So if you settle your contract or your payments early, you get a 2% discount on the payments that were remaining. Remaining amount of the loan would be discounted at 2% or 0.25%, and that is a bit of an incentive. So in some cases, you would see breaches, an application of breaches are done from a financial point of view to recover money quickly or to get payments back quickly from investors or from consumers in some cases, and they would also be examples of breaches. But the solution to solve that breach is done by applying a bit of a financial penalty or a bit of a discount given to those early settlement on loans. But sometimes breaches, when it happens between companies, and when we look at these going into litigation, you would generally see one party would claim damages because if the contract has not been fulfilled, assuming as an example, just to quickly explain, a developer is looking at building some houses, and it's a big development which is coming up, and some of its partners actually are not able to supply material. And in the contract somewhere they have been written that if the material supply is interrupted, not provided, or not, if they have not been able to provide that and maintain that supply on time, other than by the act of God, then in those cases, the construction company or the developer can actually claim damages by suing the party or taking the supplier to court. And in those cases, the damages or damages being claimed are covered under breach, and these damages could be financial, and that would mean they would be liable to recover not just interest costs, but delays or wages or salaries of workers, which the developer is actually paying in terms of when the non-deliveries deliveries have not happened. And there could be lots of other remedies. So one is damages when you claim financial compensation, and the other could be other types of remedies that you try and build in. So in those cases, these are all defined under the terms and conditions of the agreement. And when an agreement is signed by both the parties, and it becomes enforceable in the court of law, and that would then become a contract. So this is a brief about what is contract law and what we are going to be looking at in a very, very, I would say, micro understanding sense, macro understanding, bird's eye view, of understanding of how contract law, or what is contract law, what are the elements of contract, how a contract is formed, and, what are the various regulations or acts that we need to be aware of sometimes when we deal with contracts or when we are signing contracts. And, in some cases when they are not fulfilled, what is a breach, and, what are the terms and conditions that need to be, looked at from a point of view of its implications, which could lead to either damages or other forms of remedies. And these would all be covered in what is called the contract law. Is this okay? Any questions on this so far?
No.
Okay. Now okay, that's great. So let's look at now, the first assessment criteria, which talks about analyzing the elements and nature of contractual agreements. So now that we've understood that what is contract, what is the branch of law that we deal with when we look at signing agreements or, agreeing to, so let's say, getting into agreements, then that would be essentially the, side of civil law. And under civil law, we are going to be looking at, dealing with contracts. And in this case, contract law would need to be invoked if, in some cases, the delivery party or, the two parties involved do not conform to the deliverables which have been agreed to from either side in terms of providing these services. Now, when we look at, in general, contract law, what I would want to do is show a bit of a practical implication in terms of how this is applied. And what I would do is play a small video here, which will essentially allow us to understand, the basic bits in terms of, contract law. So just give me 1 second and let me just play that video, which gives us a bit of an understanding in terms of how in what different situations we can actually look at, we don't realize, but obviously we see that these are situations in which, contracts are essentially exchanged or, applied.
Contracts are everywhere.
So just to confirm, is everybody able to see the screen?
Yeah.
Okay.
Just
Fine.
by way and do all that. When you come back and they say, we'll find out a couple of you, might ask, why do we have contracts? Contracts. It's as if I were offering to teach you a course on the internal combustion engine. Now,
so that gives us a bit of an idea in terms of what we want to understand when we talk about, contracts. So I'm not going to go into the full video. Obviously, this is a part of series which Harvard Business School has produced. And obviously in that series, what they do is they go through different forms of contract. But at this stage, what we are primarily going to be focused on is understanding the relevance of this, which is primarily for the case of accounting. And when we go with this particular detail, what we want to be able to do now is to get into the assessment criteria that we want to look at, and they would be related to the first part, which is analysis of the elements of contract law that we want to see. Now, as I mentioned earlier, what we want to be able to do is understand where does it come into way and why do we need this legal framework essentially when you provide services, when we look at providing those services. Because sometimes what happens is when you look at clients and their interpretation of why they want these services or how these services are to be provided, at some stage you need to bind them into an agreement or create some sort of a boundary which allows us to quickly resolve and come to a conclusion that these are the deliverables which we are going to provide. These are the deliverables that or things which are going to be expected of you for us to provide, and the end result of this particular workings that we do would lead to the creation of, say for example, the accounts for your company, or in some cases, your personal tax and things like that. And at the end of it, when you approve these accounts which have been created, what will happen is we'll file this with Companies House, or we'll file this with HMRC, and you will essentially get, an acknowledgement for that. And in return, what we want is the monies to be paid for which this whole agreement or this contract has been put into play. Now, when we understand that these deliverables, there could be a bit of debating, there could be a bit of discussion, there could be a discussion on prices, the kind of services that you provide, whether there will be some interim accounts done, what will be the frequency through which you'll provide these, basic bits which are required to compile the accounts. All those things will essentially be covered in what is called the various documentation that will come to you from time to time from your client. And when we talk about, the documentation, they could be in the form of, receipts, they could be in the form of, salary slips, bank statements. It could be all forms of information which is required that you specify at the beginning, at the outset, when the agreement is being signed, or when this agreement is being signed into a contract, that these are the bits that we would need in order to produce this final report or this output and this statement. So when we talk about what all will be required, we will look at forming some sort of a contract. In most cases, we end up using certain standard defined templates which are available. And sometimes these templates, when we use them for, signing on a contract or creating a contract between ourselves and the client, or between two companies, they would typically be going through the constituents of 7 elements of contract law. So at some stage, when the contract is formed, the agreement is signed, and it is signed by both the parties, it becomes a contract, and that is the formation of contract. Now, there are elements of it wherein the contract has to be made, contract has to be understood, any exclusion clauses have to be included. If for some reason the contracts cannot be delivered, then we have to look at mitigating factors which have to come in, and then clear roles and responsibilities in terms of discharge of duties or obligations which have to be done, also have to be defined in the contract. And if for any reason they cannot be delivered, cannot be completed, or you fail to deliver the contract, or either party fails to deliver the agreed deliverables which have been specified on the contract, then in those cases you fall back onto what is called remedies in terms of how to resolve when issues and problems crop up. Now, these bits have to be explained in the first task, which basically talks about analyzing the elements of contract and the nature of contractual agreements. So here, what I would suggest is, after you've understood the basics of how a contract is formed, the 7 elements of the contract, and exclusion clauses or terms and conditions and remedies or breaches, the idea would be to take up a practical example here and then use that as an example to include in the assignment, and that would essentially help you accomplish the task 1.1. So a simple case here that I would suggest would be to take a part of a contract that you might have with some of your clients, which could be an agreement which has been done or maybe a couple of years back or several years back, and that would be a contract that you put in, bring into play, and that could be anonymized in certain areas, or the information in certain areas could be hidden. And that would basically, what I would do is basically pick up a practical contract or an essential, real contract, and in that contract basically highlight some of the, key elements that we normally talk about when we say a contract is formed. So we talk about, the terms and conditions. We talk about, the finer prints, which basically tend to be if the contract is not fulfilled, which is, looking at breach. And in some cases, talk about the deliverables from the client, deliverables from the party which is fulfilling the contract, and they could be highlighted using a highlighter, and that would help cover this particular part of the task. Is that okay? Now, when we look at different types of contracts, there could be contracts which are unilateral, there could be contracts which are bilateral. So sometimes when we look at contracts which are formed by one party and the other party assumes there is an obligation, would be unilateral. Bilateral contract would be when both the parties agree on a particular deal and then they try and abide by that particular deal to create that contract. So in some cases, you would see contracts in terms of deliverables tend to be that deliverables come from both the parties. But in certain contracts, the deliverables, once the contract has been signed, only come from one side of the party. And when we look at such contracts, which are unilateral, you take out a car insurance, you take out payment protection insurance. So in those cases, as long as you're paying the premiums, the delivery, if something is to happen and if you have to invoke that claim, then in those cases, the invoking of the claim, apart from the documentation that you fill, the financial side of it is fulfilled by one party only. And sometimes those contracts would then be, termed as what are called unilateral contracts. So here the example would be important because it talks about analysis, and the analysis after writing in a bit of a theory, which is to explain what is contract, the elements of contract, you would need to basically then look at, taking up an actual example. It could be an example of a tenancy agreement, it could be an example of any sort of a contract that you've signed, a mobile phone contract, and that would be good enough to cover this particular task. Any questions on this?
No.
So this particular slide that we look at, in particular, which I've shown you, when we started off with understanding the overview and then the details of it, basically, gives you a bird's eye view of how contracts are formed, what are the stages through which it goes through before a contract is formed, and if they are not fulfilled, what are the remedies or, let's say, fallbacks that you can get on in order to ensure that when you take it to law or when it goes into court, then what kind of deliverables or receivables can be done by looking at court rulings or, invoking the breach conditions which are defined in the contract. Now, the second part of the task, that we look at, the second assessment criteria, is basically looking at explain. Now, there are some basic bits that we need to look at. One, we'll get into that now, which is it talks about explain the principles of agency and their impact on business practice. Now, one of the things that we need to understand is that what are the principles of agency? So when we talk about principles of agency in particular, we basically are talking about, the area of commercial dealings that are going to be set out when we do or arrange contractual, let's say contracts are arranged. And these contracts, they can be arranged in person by an agent or an agency on your behalf, or it could also be done by a third party, which is called a fiduciary, and they would then still be representing you as a client, but will be responsible for, let's say, carrying out some of the basic bits of actions to create that contract. So when we talk about the principles of agency, there are, when we in general talk about, if I say principles of agency, what I mean by that is that these are terms and conditions or, things which are defined under what are called law of agency. And this law of agency basically is a remit under the commercial law, which basically sets out the dealings of how the contracts can be negotiated, agreed, and signed between a person, agent or representative, and last but not the least, if somebody is dealing on behalf of that person, and then they are signing that contract as a third party, and the whole aspect of the operations involving the individual, the agent, the agency, and somebody acting on behalf of the client as a third party to create this contract would be called the principles of agency or law of agency. And this is something which falls under the remit of what is called commercial law under, when we talk about private and public law. So under public law, this comes under commercial law. Now here in this task, what we are looking at understanding from our point of view is how are the laws of agency going to be applied when we are looking at dealing with our clients who are directors of their companies, and how they are going to be looking at fulfilling some of the responsibilities in some cases when they work as a director or the managing director of a company, and they look at their responsibilities which have to be completed, or role and responsibility that they have to deliver on behalf of the company towards shareholders, employees, partners, suppliers, or any side of let's say shareholders which would have vested interest in that company. So the agency theory looks at or law of agency or agency theory, principles of agency, whichever way we call it, actually look at dealing with this side of affairs, wherein directors of the company which are running the operations on behalf of the shareholders have some sort of roles and responsibilities to be delivering at the end of the year to achieve the objectives. And in those cases, when they look at delivering those services to achieve the objectives that the company has set, and their responsibilities towards shareholders or stakeholders within the company. Stakeholders would include employees, employers, partners, suppliers, government, shareholders as well. And when we see problems arising, when the roles and responsibilities are not fulfilled, then we will fall back onto what are called the laws of agency or principles of agency to deal with such problems when they arise. So here, when we talk about the law of agency, we need to understand and put into context certain parts within this particular law. So one is, who is an agent? So agent is somebody who is employed by the principal to carry on the task. Then we look at agency. Agency refers to the relationship between the principal and the agent. So in this case, client and the agent you can mention. Then when we look at agency cost, these are costs which are incurred in the route of carrying out those roles and responsibilities, and these costs have to be reimbursed by the client or the principal in this case, and the agents would be looking at spending this cost upfront in good faith, and they would then be sending receipts or reimbursement claims back to the client or the principal in order to recover those costs as and when it has been agreed in the agreement. It could be at the end of the month, it could be upfront in some cases, or it could be when the full contract or the services have been delivered. And when we see that this contract is agreed and the agency, or in this case the client, agrees to look at say agreeing to these principles of dealing when they are being delivered by a third party or by an agent, then in those cases, we would see if there are issues which arise or if there are conflicts which arise, then they are going to be dealt by looking at, using the law of agency or principles of agency. Now, in order to put this into context, I'll explain, or I'll take up an example. Suppose you decide to put out your property on rent, contact the lettings agent, and you basically sign a contract. Now, you're not looking at paying anything upfront because there's no upfront fees involved, but the letting agents will look at, making a list of your inventory, do some photographs, put your house or your, apartment, whatever it is, and create some listings for it, list it on certain websites, and they will then start to get some interest from, customers. the viewings will be done, and at some stage what will happen is they'll come to a situation wherein they will give that back to you to say, okay, we've got 2 clients which are interested, they're offering this rent, these are the terms and conditions, should we go ahead and finalize. So when you say that so in this situation, if you look at, we can relate 3 people that are happening and are using the law of agency. One is the lettings agent, which is acting on your behalf. The client, which is you, or the principal, which is you, because you have the property, you are the owner of the property and you are actually deciding to let it out. And then the clients, which basically are looking at being tenants, will be occupying your property. And in between the process which is being done by the agent, which is the lettings agent, and as an agency, because that's a business, so they are doing and carrying out some of these activities to basically look at putting your property into the market, successfully letting it, doing some paperwork, which is signing a contract between the landlord and the tenant, and then making sure all the deliverables are done. And the end of it, what they will do is they'll send you an invoice to say, okay, we've agreed and we've done and delivered to what has been discussed as the contract. The property has now been let, and that's a piece that they send an invoice to you. And that would show you a bit of an example of how you would see, the law of agency or principles of agency being used when you have an agent, you have an agency, some cost, some client, and a principal involved. And this kind of an arrangement, which typically tends to happen when we see this working, would be under the laws of agency. Now, this would also happen when we look at relating this to an accountancy practice. So if you have an accountancy practice, you have a number of clients, you have a number of accountants or your partners or, various people working within the agency. They manage and work with different clients on a day-to-day basis. They're dealing with and providing lots of different types of services. So the person who's directly dealing with one of the clients would be, looking at servicing the requirements of that client, would be then an agent. The agency under which, or the accounting practice under which they are working, would be the agency. The services that you have provided, or you've agreed to providing throughout the year or towards the end of the year, whichever way it works, would be the services that would be provided to your client, which could be, say, for example, cash flow statements, profit and loss, at the end of the year accounts which are done, balance sheets, submission to company's house, maybe doing some payroll in the middle, or whatever it is. Then those services which are being provided would be provided on behalf of the agency, and you would be regularly billing the client, and somebody who's looking at front-ending that from a point of view within your team would essentially be dealing as an agent. So in this case, the principal is the client, which is the client receiving the accountancy services. The accountant, which is working within your firm and who provides these services on a day-to-day, weekly, monthly basis, is the agent. The company, which is the accounting practice, would be looking at the agency cost, and at some stage, you would be looking at the, you would have had a contract or signed a contract with the client and agreed to delivering these services, and they would all fall under the remit of what is called the law of agency. Now, if there are problems, issues, or, let's say conflicts which arise, then they are going to be resolved using this particular aspect of, law of agency. And if we go into a bit of detail with regards to this, would be if you help your client form a new company. When a new company is formed, you look at, the memorandum of articles, the directors, the shareholding, and all those things being defined. Once that is done, a company gets created. If there are bits and pieces that you look at changes, like maybe a change of ownership, change of company name, you look at adding a partner or a shareholder to the company, various forms like TN01 have to be filled in on company's house. They would all be done by the accountant or the accounting firm or the practice, and they would then be done on behalf of the client on their instructions, and these would then all again be falling, which is under the laws of agency. Is that okay?
Yeah. Yeah.
Yeah.
So when we look at going into a bit more detail, so when we go into a bit of detail, and then we look at getting into details of, the directors of the company and their role being separated from what operations and roles and responsibilities they have within the company, would be in that case, looking at some part of it, which is basically dealing with the laws of agency. So how do you separate the roles and responsibility of the directors. If the director in this case is the director of the company and also a major shareholder, then what you want to be able to do in this case is understand how the role and responsibilities of the directors of the company who are also the shareholders, like say, for example, some cases, smaller companies, you'll have the directors being the shareholders as well. They would be 50, 60, 100% shareholders. Then in those cases, how do you differentiate their responsibility with the responsibilities of the directors of the company? And in those cases also, you will look at the use of laws of agency. Now, a fiduciary sometimes which gets involved, which will, kind of be responsible for dealing with the responsibility of the, director. But in this case, when I say fiduciary, that would mean that somebody who is made responsible for, looking at the responsibilities or the execution of these responsibilities on the behalf of that person would be termed as a fiduciary. So in this case, there would be an establishment of trust, and the beneficiary in this case would be the director, but somebody else, in this case, if the director is also a shareholder, and if certain roles and responsibilities are executed, and at the end of the year, you get a salary, but you also get a director's bonus, or you get, say, for example, you draw some dividends from the company, then in this case, you would generally see that this is going to be done through the accountant, wherein the dividends would have to be declared on the balance sheet, or in this case, for example, any such bonuses or incentives which are provided to the director, who's also the shareholder in the company, would have to be declared in the accounting statements. And that is where, a fiduciary, that means somebody who would be acting on the behalf of the shareholder. In this case, it could be when you look at doing the minutes of the meeting, the secretary would basically, and the board would, do, for small companies, you would look at the accountant, the secretary, and the director doing a bit of a meeting to say, okay, this has been agreed in principle, sign it off, and then they are, reflected in the financial statement. So in those cases also, you would see how the laws of agency are put into place in order to ensure that everything being done is being done as per the rules and regulations specified in the Companies House Act of 2006. And they also look at using the laws of agency when the director of the company is also the shareholder within the company. But when we look at some of the large companies in the UK, small, medium businesses or large PLCs, you would generally see that the directors in the company are normally not shareholders. And in some cases, when we look at, the data which is published by CBI, directors own in large companies, they own less than 1% of the shares in the top UK 100 largest companies as per their analysis that they've done. So in some cases, in order to ensure, that there are no conflicts of interest which arise between the directors of the company, who can also be shareholding or having shareholding in the company itself, we use the laws of agency to ensure that the conflicts can be negated, or if there are conflicts which arise, then they can be resolved using the laws of agency or principles of agency. Is that okay?
Yeah.
Now, the other bit which we also look at in this case would be when we talk about, corporate governance. So if we have to expand this into an understanding of how laws of agencies are applied, when we talk about corporate governance, corporate social responsibility, we generally see that companies which are owned and managed by same people, that means the director of the company is also the 100% shareholder. And in this case, sometimes you see companies which are created are called limited liability companies, or companies when a small company or a business is formed and they form it as a limited company, you generally see that in this case, the liability of the business can extend into the liability for the director of the company as well. And in order to separate those two liabilities, we also again use the laws of agency in order to bring this into practice and ensure that the company's liabilities to the director of the company, even if it's a 100% shareholder and the sole owner of the company, does not become liable for company's liabilities as far as his personal asset and personal belongings or personal finances are concerned. And there are laws in the Companies House Act wherein obviously directors in companies can be debarred from becoming, people in the companies can be debarred from becoming directors for a period of up to 3 years if they find misgivings or fraud which has taken place, and if such misgivings and frauds are taken to the court of law, people can be debarred from becoming directors in future companies, or be restricted from becoming a director for a period of up to 3 years. And they would also be looked at when you look at formation of a company, and some of these questions that we have to ask as accountants when a person approaches you or a client approaches you. Say, okay, I'm looking at forming a company, these are the sets of documents, these are the bits that, and then you advise them in terms of what kind of a company would be best to form, whether it's a sole trader, partnership, limited company, limited liability company, or in some cases, obviously, when businesses go to large practicing firms, they would look at understanding the rule of law, what are the various minimum statutory guidance and compliances they have to meet, and that would allow us to give them the right advice in terms of the formation and type of company that they need to form. Is that okay? And one of the reasons why this is important is that if we look at the prominent list of scandals which have happened because of accounting and financial accounting practices across the globe, we are aware of a lot of names, but this is just a slide to explain why the laws of agency are very important, and the role of the directors have to be separated from the day-to-day workings within the company if they are also shareholders. And this is something which is reflective of the fact that there are lots of scandals which have happened wherein companies have over-reported profits, they've over-reported or under-reported inventories, or over-reported depreciation costs in order to increase the bottom line or profitability of the company. And when we look at these companies doing that, they are all classified into what are called examples of accounting practices which have not been used to the regulation which have been set in that country, and that is why it leads to these large frauds which have happened, and a lot of companies and investors and shareholders losing money because the companies have gone belly up or bankrupt. So this is the reason why the laws of agency are very important when we look at specifically accounting and accounting practices. Is that okay? Any questions on this? Okay, we'll go into the second part of the assessment criteria very briefly, which will be the law of torts and why, this is also important. So when we talk about, law of tort, essentially what we mean by that is that, this is, in short, this is a civil wrong. That means, there is some sort of a breach of contract which has happened. And when we look at the breach of contract which has happened, that means somebody somewhere has done something wrong against another person, and because of which this wrong has been done, the other person or the party is liable to recover damages, or let's say recover costs, because the contracts in these cases have not been fulfilled to what has been initially agreed when the contracts were signed. So there's a subtle bit of a difference when we say law of tort and why this comes into play and how they are different from contracts. Is that when we talk about differences between the two, what we basically mean here is that a contract, in some cases can be a verbal contract, can be a written contract, can be an implied contract. But when we talk about, law of tort, then what we mean in this case is sometimes you would see that contractual relationships do not get established and a claim does not arise if the relationship between the two parties in terms of delivery of the contract has not happened. So in this case, when we say, sometimes we also talk about, I don't know how many of you are aware of, have you heard of the term called postal rule by any chance?
No.
Right, okay. Now, okay, so a postal rule is normally, it's a case in point where, sometimes contracts, when they are signed by parties, you normally would post that contract in the post, and unless the other party receives that contract and they then agree to have received that contract, the contract actually does not, come into force. So sometimes you would see when certain things have to be signed. Today we see this happening through the e-signing of documents. So because of COVID, we don't see physical contracts being signed. Most parties would, send you an e-document for you to sign, review the contract, and when you sign it, a copy of that you can download, and that's an electronic way of signing the contract. But in the earlier days, when this postal rule came into being in 1818, there was a case which came up between Adam and Linsell, and the idea was that the other party had agreed to sign the contract and had put it in the post, but the party which was supposed to receive it did not receive it, and hence the contract was not, materialized because the other party did not receive the documents through the post. So this way of basically looking at accepting the offer or the offer of the other party, wherein the contract has been signed but has been posted through the postal route, and the other party has to receive it before it can come into effect. And this is why the postal rule comes into play. So similarly, when we look at contractual obligations, when we talk about law of tort, what we essentially mean by here is that the other party has to commit a wrong before they can be tried in the court of law. So sometimes you would see the contracts to exist, a crime or of non-fulfillment has occurred, a wrong has been done, but in this case the claimant would not decide to go for compensation, or would look at solving some of these things outside the court of law. So there are lots of different types of law of torts, and typically there are ways through which sometimes parties are encouraged to have out of court settlement. And in some cases, these out of court settlements, which can be done because there's an existing relationship which entails between the two parties, allows some of this, allows the breaches which have happened in the contract to be resolved out of the court. And in those cases, we talk about, the law of tort. So this law generally comes into play. An example of this, a very simple example of this I would give you, going back to what we discussed earlier, and I took that example saying that your property has been let out and you have a tenant, and the tenant has agreed to pay rent to you on 1st of every month. Now, everything is going fine, but in one of the months, the tenant does not pay the rent on the first of the month, and the rent comes to you on the 7th. Now, in the contract, it has been specified that for any day which the rent is not paid, you're liable to recover certain interest costs on the top of the principal which was supposed to be paid. Now, in this case, what would happen is when we apply the law of tort, you would generally see that, yes, if the rent has not come on the 1st of that month, there is something in terms of wrong which has happened. That means, as per the contract, the tenants were supposed to pay the rent to the landlord, but it's not happened on that date. When they inform you that it's happened because of this and this, and they promise to pay you on the 3rd, and you obviously do not take any remedial action in terms of recovering the interest cost for the late payment of 2 days, then you generally do a settlement which does not require you to invoke some of the terms and conditions of the breach of law happening in the contract. And in those cases, you would generally see that although a crime has been committed, or although the contract has not been fulfilled, some sort of a wrong has happened, but you've still resorted to resolving this out of court, and some sort of a settlement has been reached. So in some cases, when you look at law of tort and you look at remedies which are available, is what we need to cover in this particular task. Now, when we look at law of tort, there are different elements involved in that. There is tort of negligence, there is defense, negligence by professionals, and in some cases you also talk about law of tort being passed off to a third party for them to settle. And we see this happening in our practical day-to-day operational stuff, when we see some parts when the contracts are done. Obviously there are delays which happen, or if things sometimes are not delivered on time. But what tends to happen is that in some cases you have to then segment it or divide it into whether this has happened. When I use the term, or when I say the phrase, you've done wrong, but this is a wrong that has been committed, or something which has been done is unknowingly being done, something that you are aware of and you know about it, and that has been done, and you've stretched it, because if the rent was to be paid on the 1st and you've seen that the landlord is a bit lenient, and if I pay by 7th also works, pay by 10th also works. But if it becomes a habit and you're doing it wrong on unintentionally, but if it was a one-off, it was unintentionally, but now you're doing it intentionally, in those cases, the different type of law of tort can be brought in. And in some cases, if you had made somebody responsible to pay those, say for example, the rent. So in this case, the lettings agent is responsible for collecting the rent, and they collect it on time from the tenant, but they give it to you maybe 10 days later, which is not a part of the contract. So in this case, the negligence has happened by professionals. That means an agency, and this has happened knowingly or unknowingly, can be established, and again, which you would invoke, what is called using the law of tort. And in some cases, some of these have to be looked into from a point of view of understanding that whether you will look at settling some of these or recover damages, by mutual consent, by discussing it because there's a relationship established between the client and the person or the agency which is delivering the goods and services. And in some cases, if it goes to the court of law, then what damages, what liable damages are you trying to recover, and they will all be covered under this particular remit. So in essence, if I have to explain the law of tort, what I mean by that is the law of tort actually determines whether a person should be held accountable for a wrong or a wrongful act which has been done, and whether that's been done knowingly or unknowingly, and has that caused any sort of a, let's say, damage to the business, or in some cases bodily harm or injury, and that would then entitle the person to receive compensation, or in some cases damages that can be recovered, and that side of dealings that are normally done would be covered under the law of tort. And the law of tort generally has 4 elements. So when we talk about these elements, we talk about the duty, which is defined in the contract. What is the breach when the duty is not delivered or when the contract is not fulfilled? What is the causation, or what is the reason of that duty not being fulfilled or the contract not being fulfilled? And what kind of wrongful doing has resulted in the damage which could be recovered is all covered under what is called the law of tort. So again, here this task is basically explained. So you have to theoretically explain the law of tort, which has been done on these slides. It explains and covers some of the components or elements of law of tort. And then what we want to be able to do is use an example to basically explain this towards the end by stitching in an example. And that could be done by using one of the case laws that we have given for additional study, on Moodle. So the neighbor's principle, which is an example of law of tort which is being applied, and this has been summarized in terms of this case law, which can be quoted from the slides, and that would help accomplish this task, which talks about explain the law of tort and what are the remedies which are available. Is that okay?
Yeah, fine.
Okay, good stuff. Let's look at quickly the 2 assessment criteria, which is one on merit, one on distinction. Now, in the merit criteria, it is asking us to assess the validity of a given contract. So again, here, what we will need to do is basically take up a contract, and that contract would have to explain where are the validity clauses given in that contract. Now, practically, if you ask me to do this as a task, what I would be more comfortable doing is pick up again a client contract that you have or you can get hold of and anonymize some of the important bits of it. And in the contract itself, if you take a bit of a screenshot and pick out what are the terms and conditions given, which basically focus on the validity of the contract. And that itself would help accomplish this particular task. So the idea is, when as accountants, when as people working within this profession, what we want to be able to see is that sometimes you see dates, which is when you take out an insurance contract, when you take out, say, for example, a policy, you normally see there's a validity clause in the contract. Now, sometimes you have a cooling off period, and that cooling off period tends to be, 28 days. If you do not find the terms and conditions to be, suitable, you can go back to the company and say, okay, I would like this contract to be cancelled. And that is giving you a cooling off period, which is primarily under the Consumer Act, which is there. But after the contract has been agreed and you've agreed to pay the premiums for the year, what you will generally see that it has a date of validity, which is the contract would come to an end midnight of 7th November, 2021. And after that, your car will be uninsured, or your, contents in the house would be uninsured, or in some cases, if some sort of an insurance has been taken out against payments that you receive, when we talk about payment protection insurance, if the premiums have been paid, you've taken out a limited liability policy for the company or the accounting practice, you have to renew that policy, and the validity of the policy, the time period in which it is valid, and if the premiums are paid on time and things like that, then that explain or cover the validity in that contract. So that is what needs to be covered in this particular task. And we've given two examples, which are traditional examples from the law side, and they are Feldhaus versus Bindley, and then the other one, in this case, obviously the postal rule has come in, and the other one that we've quoted is Adams and Linsell, which basically was the precursor of why postal rule was introduced as a clause when we talk about tort law, and in general talk about why contracts and tort law have to apply this principle of the postal rule, because sometimes contracts are formed, again going back to the agency thing, wherein you have the agent, the principal, and you have a fiduciary or a third party who's dealing on your behalf and expediting all the roles and responsibilities which have been given. And then in those cases, sometimes contracts cannot be formed or get voided, or in some cases, do not get formed properly. And this is because in some cases, when you have clients or you authorize somebody to sign on your behalf or give the power of attorney, or say that this is the person who will be signing off agreements on my behalf, but till such time they are received back by the party who's actually signing the contract with you under the postal rule, they do not get validated till the other party receives it. So this has to be covered by looking at explaining the validity part of it in the contracts. And I could pick out a simple contract that we would normally do or sign a contract with our clients for the accounting side of things. And in some cases, what we do is you would normally put the contract date, which is it is valid from this date to this date, and what is the validity. And if these things are met, which is the bullet points that you define, that payment of this documentation which is to be received, and then the deliverables are to be put into place, that would cover the validity side of things. Is that okay? Any questions on this?
No, it's fine.
Okay. Now, the distinction part of the criteria basically talks about evaluating the implications of agency relationship for basically looking at bringing into play the law of agency that we looked at earlier. So here, when it talks about evaluation, what we will have to do is basically talk about how does the agency relationship come into play, what are the laws of agency, what are the key components of laws of agency, which is the agent, agency, and the third party and the client, and they have to be explained again using an example. So in some cases, I would have explained this by looking at sometimes when contracts are formed, and they are formed between different companies, and you're dealing on behalf of the company as maybe accounting partners, or looking at as an accounting practice, you would generally come out with notes which are done towards the end of the year, and they tend to explain some of the key bits in the accounts or financial statements which have been produced. So in this case, what happens is when you look at putting some of these statements across, you have to run them by your client, because some of them could be nitty-gritty in terms of providing information which they do not want that to go into public domain. So when we look at such implications wherein you have to put information as per the IAS 7 standards when you draw up these statements, but they have to be done so in a manner wherein any improprieties, any misinformation which is there or can be used to prepare those financial statements have to be clarified and cleared with the client, would involve the agency relationship coming into play when we talk about the laws of agency. So here, sometimes as accountants, as people working in this profession, what we do is go back to our clients and basically tell them that, okay, these are things that we need to be taken care of. Maybe in small company and businesses, you would generally see directors drawing out a lot of money from the company, and the DLA or the director's loan account tends to swell up. So at the end of the year, when the accounts have to be finalized, either the DLA amount has to be put back into the company because it's a director's loan account, or in some cases that money has to be taken out as dividends or bonuses, and that should still allow the company to report accurately the status of the DLA account, or in some cases the amount of money which has been drawn out by the director who's also a shareholder in the company, but have to be booked onto the final accounts which are being submitted to Companies House, and they have to be booked either in the dividends as bonus or as wages or salaries, whatever it is, and that establishes this particular task, because by taking such an example, what you'll be able to explain is the relationship between the agency and the principal, and in this case, the agency or the agent being the accounting practice and the principal being the client, and the use of example of the DLA would actually help evaluate the implication of that for financial statements when they are compiled and then submitted at the end of the year as finalized accounts to Companies House. Is that okay?
Yeah, fine.
Good stuff. So with this, we come to the coverage on the first learning outcome that we set out to cover. A bit theoretical, but it is mostly related to getting you an understanding on the law of contract, law of tort, and how we can contextualize and relate some of these when we do our day-to-day operations in terms of running an accountancy firm or as an accountant, some of the operations, and how do we relate some of these to those functions that we do on a day-to-day basis. So what I'm going to do at the end of this session is obviously have this revised presentation uploaded along with a copy of recording, and the other bit which I'll upload also as Word documents would be some examples which you would need to look at, or maybe similar type of examples that you can use to bring into your work when you do the assignment at some stage for LO1 and some of the tasks that you cover, but they would be used as examples of showing, the law cases which could be used to bring out analysis and evaluation. So it will be related to, 2 or 3 laws that are on the slide, quite detailed, but they would be available as Word documents in particular, and for you to use when you do your tasks later. Okay, that's good. So any questions? Let me go one by one just before we end the session. Mr. Hawk, any questions at your end?
No, fine.
Lorraine, any questions at your end?
No. I think for me, Roman, you know how much I struggle with assessments. Is it possible to start the assessment with today's lesson and then sort of work the way through it, or would you recommend? Because I seem to have problems doing it all at the end. So what would you say would be best for me to do it lesson by lesson?
I think for this unit, I would recommend that if you do it lesson by lesson, because this is mostly theoretical. So while it is fresh, when we do the, our discussions, it will be good that you could look at the assignment brief and also start getting into it on a task by task basis. And then towards the end, they could be submitted all in one go as attachments, because that will be easier for you to manage and obviously easier for you to do. I think that is the recommendation. It's a very good question, and I would say if this is something which could apply pretty much to everyone who's doing this unit, because you'll have to reference a few case laws, and you'll have to at some stage, look at basically reading into it. So it's a bit of a theoretical unit, and that's where I think doing it on a task by task basis just after the sessions would be much more beneficial than obviously leaving it towards the end.
Okay, lovely. Thank you, Roman.
Okay. Rajiv, any questions at your end? Tarun, any questions at your end? Okay. Okay, that's great. I'm not too sure. You were two.
Yogesh.
Yogesh, hi, sorry. Hi, any questions at your end?
No, I'm okay. Yeah.
Okay, good stuff. And then I have somebody who's viewer 6.
Oh, that's Andy.
Sorry?
It's Andy.
Oh, hi, Andy. Hi. Any questions at your end, Andy?
Hopefully not. I think I may be on top of this already.
Right, okay, that's good.
But if I've got any questions, I will email you.
Yeah, so I think if there are any questions, my quick suggestion would be you can either send an email to LearnerWork, or you can send an email to me. which is at raman@ukversity.co.uk, and I can get back to you pretty much straight away. So I think I'll end the session or the recording for now.